Good Monday. This is Jay Brew, co-chairman of Seafried and Brew. Well, some good news, of course, from Friday's employment number. But as we've talked about over the past couple of months, what we want to do is look at the overall labor market. And we had a bounce back from the previous month. In fact, last month's was revised. As we talked about when we first talked about this labor market conditions index, we talked about it from the standpoint is that, as we can see, there is some volatility. But we had a move up in terms of the index to over 6 after taking into account not only the unemployment numbers, the employment numbers, but the participation rate, etc. But yet, after that number came out, which was good news on Friday, the 10-year Treasury, which was sitting right around at 2%, suddenly moved down to where we are in here today at about 1.93%. Why? Because overall wage growth actually was a negative for this particular series. So when we think about that employment cost index, which will get a new number coming out in here, the thing that we've said is that since the recession, this has been a relatively flatline number in here. And when the Fed is looking at actual wage growth overall, especially with what came out on Friday, it's got to be worrisome. More jobs, but it's just not having any push on wages, which once again is the other part of the Fed's conviction, which is on inflation. And when we look at what happened in Europe last week in terms of the disinflation word arising, is that we go back to the commodity index in here. And we've been watching this carefully, seeing commodities continue to move downward. With every dollar drop in oil, it's having impacts on other commodities in that commodity basket, getting down to levels now lower than where we were at the depth of the recession. And this is a central worry in here, that there's no push. There's no push in prices. Oil, of course, being a huge catalyst in here. So when we look at overall rates in here, is that we look at comparing the 10-year Treasury in the U.S., Japan, Germany, and the U.K. And we did this a couple of weeks ago when we talked about, can the 10-year even go lower in here? Could it get below a 2% when it was up more at like a 2.20? And the answer, based on this chart, is yes. It may say that the 10-year Treasury might be heading down to closer to 1.5% in here, would not be out of the question. Because the thing you want to watch is last year at this time, the 10-year Treasury was at a 303. The UK was at a 302. Now we're looking at our 10-year Treasury right around that 194 level compared to their Treasury at 1.56%. And of course, we look at Japan getting down to 0.26%, Germany at 0.49%. Once again, that disinflation word will become a worry in terms of the Fed, because when we look at this on an overall global basis, it's saying that there could be a slowdown in overall worldwide economies. And definitely those commodity prices are leading that. This is Jay Brew, co-chairman of Seafried and Brew. Have a great week.